Good morning, America. Today we're about to embark on a journey through the remarkable early life of Warren Buffett, a story that proves greatness often starts in the most unassuming places. Today, we're diving into the story of Warren Buffett, a man whose patience, discipline, and unwavering principles built an empire from the ground up. Before he was known as the Oracle of Omaha, Buffett was simply a young man with an insatiable curiosity for numbers and a relentless drive to uncover value where others overlooked it. His journey didn't begin with a revolutionary invention or a stroke of luck, but with a simple, powerful idea: buy good businesses at fair prices and hold them for the long term, letting time do the heavy lifting. As a boy, Buffett delivered newspapers, sold packs of gum door to door, and hustled to find any opportunity to earn and save a few extra cents. He even ran a pinball machine business with a friend, placing machines in local barbershops and splitting the profits, a true entrepreneur from the start. He learned the basics of investing from his stockbroker father, who introduced him to the world of stocks and financial markets at a young age. Hungry for knowledge, Buffett devoured every book on business and investing he could find, spending countless hours in libraries, absorbing wisdom from the greats. At Columbia University, legendary investor Benjamin Graham taught him a lesson that would shape his entire philosophy. Stocks aren't just numbers, they're pieces of real businesses, with real value. In 1956, with a modest sum pooled from family and friends, Buffett launched his own investment partnership in Omaha. Far from the noise and chaos of Wall Street, he ignored market fads, studied companies deeply, and searched for strong businesses that were temporarily undervalued. His partners placed their trust in his careful judgment, and he rewarded that trust by delivering returns that consistently outperformed the market year after year. Buffett was always transparent, writing detailed letters to his partners that explained his investment philosophy, decisions, and the reasoning behind every move. He treated his partners' money as if it were his own, always putting capital protection and long-term growth above risky speculation. This integrity, paired with clear and honest communication, became his secret weapon, setting him apart in a world often clouded by hype and short-term thinking. These early years built the rock-solid foundation of trust, discipline, and patience that would come to define his legendary career. And soon, that foundation would be put to the ultimate test, as Buffett faced his biggest challenge yet, a test that would reveal just how powerful those humble beginnings truly were. Every great story has a turning point, a moment when everything changes, often in the most unexpected way. For Warren Buffett, that pivotal moment was Berkshire Hathaway, a name that would soon become legendary in the world of investing. In the early 1960s, Berkshire was just a struggling textile mill, outdated, unprofitable, and seemingly doomed to fade away like so many others from a bygone era. Most investors ran away from the company, seeing only its problems. But Buffett saw something different. He noticed the stock was trading below its working capital, a rare opportunity. Initially, he planned to make a quick profit. But when management tried to cheat him on a buyback deal, Buffett, out of sheer frustration, decided to take control of the company himself. Suddenly, he found himself the owner of a failing business in a dying industry, a decision he'd later call a $200 billion mistake, one that would haunt him for years. No matter how hard he tried, the economics of the textile business were simply terrible. The losses kept piling up, and the future looked bleak. This painful experience taught Buffett a lesson he'd never forget. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The textile business was a constant struggle, draining time and resources. Buffett knew he needed a new direction if he wanted to succeed. Berkshire Hathaway, once a failing mill, was about to become the foundation for something much bigger, a holding company that would change the face of American business. But Buffett wouldn't build this new empire alone. He realized he needed someone who could challenge his thinking and bring new ideas to the table. He needed a partner with a different perspective and complementary skills. Enter Charlie Munger, a brilliant mind with a unique approach to investing. Together, Buffett and Munger would change everything, transforming Berkshire Hathaway into one of the most successful companies in history. No great leader succeeds alone. Buffett's story is forever linked to Charlie Munger. They met in Omaha in 1959 and quickly realized they were kindred spirits. Munger, a lawyer with a sharp mind, urged Buffett to look beyond numbers and focus on business quality and management. He convinced Buffett to stop chasing cheap, mediocre companies and instead seek great businesses with durable moats. This shift was a turning point in Buffett's career. Their partnership thrived on mutual respect and honest debate. Munger often challenged Buffett's ideas, making them both better investors. When Munger became vice chairman of Berkshire, they transformed it from a textile relic into a holding company for high-quality businesses. The old mills faded, but Berkshire's new vision was just beginning. Their first big move? A quirky company called Blue Chip Stamps. The key to Berkshire's future came from blue chip stamps. In the 1960s, trading stamps were everywhere. Customers collected them, and companies held the cash, called float, until redemption. Munger and Buffett realized float was a financial engine money they could invest before paying it out. They took control of blue chip stamps and used its float to buy other businesses. This self-reinforcing cycle became Berkshire's lifeline. The strategy soon expanded to insurance, where float was even bigger. Buffett bought National Indemnity and later GEICO, loving both the float and the profits from well-run insurance. Underwriting profits plus investment income from float became Berkshire's growth engine. This model would fuel decades of expansion. The snowball was rolling and getting bigger. With float fueling their ambitions, Buffett and Munger sought wonderful businesses. In 1972, they found See's Candies, a beloved West Coast brand with a loyal following and powerful pricing power. Customers loved See's, associating it with celebrations and gifts. The brand's emotional connection let See's raise prices year after year without losing customers. Buffett and Munger paid $25 million, more than they'd ever spent, but recognized its enduring value. See's required little capital and generated huge profits. The acquisition was a home run, producing billions for Berkshire over decades. See's proved that paying up for quality beats bargain hunting for mediocrity. It became the model for future acquisitions. Strong brand, loyal customers, and pricing power. This sweet success gave them confidence and capital to pursue even bigger opportunities. The lesson: buy great businesses, not just cheap ones, and always value the power of a brand. As Berkshire grew, complexity drew regulatory scrutiny. In the 1970s, the SEC investigated their Wesco financial takeover, suspecting hidden wrongdoing. But what saved Buffett and Munger wasn't legal maneuvering, it was their reputation. Everyone vouched for their honesty and fairness. The SEC dropped the charges, convinced their intentions were honorable. Buffett's guiding principle: it takes 20 years to build a reputation and 5 minutes to ruin it. During the Wesco deal, they honored their original offer, even when they could have paid less. This integrity cost them in the short term, but paid off in trust and deal flow. Sellers knew Buffett would be a good steward of their life's work. His reputation became a competitive advantage, opening doors no spreadsheet could. In business, trust is the ultimate currency, and Buffett's good name was priceless. By the 1980s, Wall Street was a battleground of hostile takeovers. Corporate raiders broke up companies for quick profits, leaving chaos behind. Buffett's reputation for integrity made him a white knight, a friendly investor companies could trust. He'd invest in embattled firms, offering stability and scaring off raiders. In return, he got great deals and long-term partnerships. His most famous move, investing $700 million in Salomon Brothers to fend off a hostile bid. His involvement alone stabilized the firm. But soon, Salomon was rocked by a trading scandal that threatened its survival. The government turned to Buffett to save the company. He stepped in as interim CEO, risking his reputation and fortune to restore trust. It was his greatest test, and a defining moment for his legacy. In crisis, everyone turned to Buffett. After See's, Buffett focused on iconic brands with simple, dominant businesses. In the late 1980s, after Black Monday, he saw Coca-Cola trading at a bargain. He invested over $1 billion, confident in Coke's global appeal and customer loyalty. The bet paid off, generating billions in dividends and capital gains. Decades later, Buffett surprised everyone by buying Apple stock. He saw Apple not as a tech company, but as a consumer brand with a loyal ecosystem. Berkshire became one of Apple's largest shareholders, reaping tens of billions in profit. The lesson: whether it's chocolate, soda, or smartphones, the principles are the same. Find wonderful businesses with durable advantages, run by honest managers, and buy at a sensible price. Buffett's approach worked across industries and eras. His discipline and patience set him apart, and his bets on brands became legendary. From the humble beginnings of a struggling textile mill to the heights of a global financial powerhouse, Buffett and Munger's empire was built on a foundation of timeless, unwavering principles that have stood the test of decades. Their remarkable success wasn't about chasing risky trades or inventing complex financial schemes. It was about patience, discipline, and above all, integrity. The first key principle was float. Insurance and other cash-generating businesses created a perpetual investment engine, providing capital to invest again and again. The second principle was quality. They shifted away from buying cheap cigar butts, companies with only a puff of value left, and instead focused on wonderful companies with enduring brands and strong reputations. Their patience allowed them to wait for the right pitch, invest wisely, and hold those investments for decades, letting compounding work its magic. Most important of all was trust. Buffett's reputation as the conscience of finance opened doors, built relationships, and secured deals that others simply couldn't. In a cynical world, they proved that honesty and fairness could not only survive, but actually build an empire. Their legacy, both in business and in life, reminds us that a good name is the most valuable thing you can ever own, more precious than any fortune. That's the real secret of the Oracle of Omaha, a truth that endures beyond numbers and markets. And it's a lesson for us all, no matter where we are on our own journey.